Have you ever thought about how far $25 a week can really go? Sure, 5 cups of coffee or 3 lunches. Yeah, it's not that much. What if I told you investing $25 per week can create a source of passive income without any hard work? Yes, you heard that right. In this video, we will explore the strategy to make the most out of $25 per week, and those low-key millionaires are seldom revealed. In the end, we will create an investment portfolio to make you over $5,000 per month in dividend income and grow your wealth to $1.5 million. Let's start the journey to make you some passive income. Before investing our hard-earned $25 every week, we need to have a solid strategy in place. Think of it like setting off on a road trip with a GPS. We need to know where we are headed before we begin. Now the challenge is we only have $25 per week and need to make $5,000 a month passively. Since the amount is not so big, we can take the advantage of time and purchase quality stocks by implementing a dividend reinvestment plan, or DRIP. This is the most efficient strategy to accumulate wealth and cost us very little effort to accomplish the goal. It is like you owning a money-making machine that is constantly printing money for you. The cost is $25 per week only. Here is how it works. When you invest, you own shares of certain stocks that pay you dividends. Now you are highly motivated. You choose to delay gratification. Instead of spending the dividend you have right away, you reinvest the dividend back to buy more shares. More shares will distribute more dividends to you the very next time. Warren Buffett likes to reinvest his dividends all the time. He calls it the snowball effect. It is like rolling a snowball down a hill. It's small and rolling slowly at first. Then your investment gains momentum over time along the way and grows larger and faster. With patience and consistency, this investment can turn into a significant source of passive income. Let's see an example of how the snowball effect works. Suppose a stock of $10 per share and you have 1,000 shares. Every year, you would receive a dividend of 50 cents per share. So after the first year, you will have 50 cents times 1,000 shares equal to $500 as dividend. Now, you don't want to cash them out. Instead, you're going to invest this amount back to the stock. In year 2, the $500 you earned from year 1 would purchase an additional 50 shares. Now you have 1,050 shares of stocks. At the end of year 2, your dividend becomes $525. This is bigger than the dividend in year 1. Same in year 3. You would have 1,102.5 shares and $551.25 as dividend. The dividend increases every time you reinvest. Over time, your investment would be like a snowball growing larger and moving faster. The benefit of DRIP is dollar cost averaging. Since predicting the market is tough for most of us, attempting to time the market can be a daunting task. By buying shares regularly, we can smooth out the market's ups and downs. This approach reduces the risk of buying at high points and allows us to acquire more shares at lower prices. Thanks to modern technology, DRIP can be set up to run automatically. Most brokerage accounts offer an easy way to enable dividend reinvestment. Once activated, your dividends will be automatically reinvested back into the stock. You won't need to worry about when dividends are paid or whether they have been reinvested. It is all handled for you, making the process seamless and stress-free. DRIP is a fantastic start. We can supercharge our investment strategy by adding an extra $25 per week to the portfolio. There are 52 weeks a year, so contributing $25 per week is equivalent to $1,300 per year, significantly boosting our portfolio's growth potential. Reinvesting dividends alone can seem slow, especially in early stages. However, by consistently adding another $25 per week, we can acquire more shares more quickly in subsequent investments, creating a powerful compounding cycle. The speed of compounding becomes more obvious as time goes. This method not only speeds up your investment growth, but also mitigates risk. By investing $25 every week, you average out the cost of your investment, buying shares at both high and low prices, and spreading your risk over time. Now we know how to apply DRIP. The next question is what we should invest in. Choosing the wrong stocks result in significant losses. Our goal is to build wealth, but not lose it. Let's set up the standard for picking the right stocks based on our situation. A stock needs to be Dividend Aristocrat or Dividend King, offer a high dividend yield, and demonstrate growth year over year. With all three factors in one stock, we can maximize our investment potential in the long run. Before picking stocks for the portfolio, let's see why these three criteria matter. Dividend Aristocrats and Dividend Kings refer to companies that consistently increase dividend payments for over 25 years and 50 years respectively. They are well-established companies that have been around for decades or even hundreds of years. So they have a track record of consistent payments, showing they are financially stable and willing to reward investors by dividends. Examples include Hormel Food, PepsiCo, and Target. These companies have solid foundations and loyal customers. For long-term investors, consistent dividend payment is preferred. Next, we need to focus on high dividend yield. The dividend cannot be very low, but it shouldn't be excessively high either. Usually, a dividend yield between 2% and 6% is considered reasonable. If a company pays a dividend higher than its competitors or the industrial average, then it is worth considering. Sometimes, the stocks with lower dividend yield may have very high dividend growth. Third, the dividend growth rate year over year should be a positive number. As investors, we don't want to see a company pay us the same as the previous year. Inflation is likely to happen every year, so we would want to get paid more money to catch up or even beat the inflation. Companies like Verizon Communications, Realty Income, and Johnson & Johnson are great examples for that. Finally, we would like the stock to grow. That means the stock price should have a general upward trend. Then, we can benefit from its capital gain along with high dividend yield. Examples are Visa, Domino's Pizza, and NVIDIA. Based on the four factors we discussed, we can narrow down to a list of 4 stocks and 1 ETF that are Dividend Aristocrats or Dividend Kings, paying high dividends and high growth. They are Nordson Corp, JP Morgan, Sherwin-Williams, Home Depot, and iShare Core Dividend ETF. For Nordson Corp, the dividend yield is 1.19%, dividend growth rate is 14.22%, and share price appreciation is 10.53%. JP Morgan is at 2.28%, 10.83%, and 13.42%. Sherwin-Williams is at 0.95%, 14.20%, and 16.22%. Home Depot is 2.59%, 17.91%, and 16%. And finally, iShare Core Dividend ETF is 2.83%, 16.37%, and 10.96%. Now let's take the average of each metric. The average dividend yield is 1.97%, and the average dividend growth rate of 14.71%, and an average share price appreciation of 13.43%. If we invest $25 per week, what's going to happen? In 10 years, the investment would grow to $22,780 with an annual dividend of $710. This is not enough to retire. In 20 years, the investment would be $131,784 with an annual dividend of $4,692. This is better, but we want to make more than this every month. In 30 years, the portfolio would be $652,262. Now the annual dividend is $26,504. We are very close now. Waiting 5 more years, the investment would be $1,451,655, and now the annual dividend is $63,014. This is equivalent to $5,251 per month. Making $5,000 is not a dream. With the right stocks, everyone can achieve it with time and patience. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.